Welcome back to XRP Unfiltered. Take a moment to get comfortable, because today's conversation is going to push back against a narrative that gets repeated endlessly. And honestly, that narrative ends up revealing much more about the people pushing it than it does about the XRP community itself. You've almost certainly come across it before. Claims that the XRP community is a cult, that holders are blindly optimistic, or that anyone who remains bullish on this technology is somehow disconnected from reality. That language is usually meant as an insult, but when you actually examine the logic behind it, it exposes something far more interesting, something that many people simply haven't taken the time to examine seriously. Once you grasp it, you start to understand why this community has remained so resilient, and why that resilience may be more important today than it has been at any point over the past decade. Before diving into the broader concept, though, there is real news from today that deserves attention, not because it fuels hype, but because it reflects tangible structural shifts taking place beneath the surface of the market. One of the most significant developments is the acquisition of G Treasury, a major firm in the treasury management space. This company is involved in large-scale settlement activity connected to tens of thousands of financial institutions around the world and is now officially part of the Ripple ecosystem. There's a clear reason this matters, and we'll unpack it, but keep this in mind for now: a firm with deep institutional relationships integrating directly into Ripple's infrastructure. While critics are busy throwing around labels like cult, institutional markets are quietly moving forward, focused on real rails, real settlement systems, and real technological integration. That criticism, branding a community as overly bullish or blindly enthusiastic, often comes from individuals who aren't actually examining what's happening beneath the surface. They react to sentiment rather than substance. Another major announcement today was the confirmation that Binomial is launching a fully regulated U.S. spot crypto exchange under the oversight of the CFTC, with XRP included from day one. For years, institutional participants have been consistent in their message. They require compliant venues, accessible derivatives, dependable collateral frameworks, and robust risk management tools before engaging meaningfully with digital assets. Now, for the first time, a U.S.-regulated exchange is offering exactly those tools, with XRP included from the outset. This creates a clear contrast within the market. On one side, critics reduce a complex ecosystem to simplistic labels. On the other, real-world infrastructure continues to expand quietly around the very asset being dismissed. Today's discussion connects these two sides, because understanding the disconnect between external perception and internal structural progress is critical to developing a realistic long-term perspective. The goal here is not to generate hype, not to promise outcomes, and not to lean into emotional conclusions. Instead, the objective is to examine what these developments actually represent, how they fit into the broader evolution of global financial infrastructure, and why accusations of cult-like behavior directed at XRP holders may actually reflect patterns that are statistically common in early adoption phases of transformative technologies. This is not about persuading you of anything. It's about providing data, context, and reasoning so you can assess the landscape independently. Whether you're bullish, neutral, or skeptical, understanding the underlying fundamentals is what matters over the long run. With that foundation set, let's move into a deeper breakdown. The first major development to unpack is Ripple's acquisition of G Treasury, a firm recognized for operating in high-volume settlement environments and providing treasury solutions that reach thousands of financial institutions globally. This is not a minor integration. When a company with that scale and institutional footprint becomes part of Ripple, it meaningfully expands the reach of Ripple's existing network. While critics tend to fixate on price movements, sentiment, or speculative narratives, infrastructure-level moves like this often serve as the groundwork for utility-driven markets later on. G Treasury operates within traditional financial products, particularly those tied to cash management, liquidity forecasting, and operational settlement. These are not speculative instruments. They are core components of financial architecture. When such a firm becomes part of the Ripple ecosystem, it naturally raises important questions. How will established financial products interact with blockchain-based rails moving forward? This isn't about forecasting a specific outcome. It's about recognizing that combining existing financial flows with digital settlement technology creates a level of optionality that's difficult to ignore. Whether this leads to tokenized treasuries, ledger-based settlement, or enhanced real-time liquidity management, the key takeaway is that integration opens doors. This leads directly into the second major development, the launch of Binomial's CFTC-regulated U.S. spot and derivatives exchange. Institutions have long been clear about their requirements before entering digital asset markets: market structure, futures, options, hedging tools, risk frameworks, and compliant collateral pathways. For the first time in U.S. regulatory history, XRP is included on a venue offering exactly those capabilities, not as a side addition, not as a speculative experiment, but as a supported asset from day one. This matters because institutional traders and liquidity providers operate in environments where derivatives are essential. They need tools to manage volatility, hedge exposure, and assess market depth. Without those mechanisms, many institutions simply cannot participate due to mandates, compliance obligations, internal risk models, and regulatory constraints. A regulated U.S. exchange offering XRP derivatives changes the available toolkit. It doesn't guarantee any specific result, but it undeniably alters the conditions for institutional engagement. What's particularly interesting is how these developments directly contradict the idea that XRP is irrelevant or sustained solely by blind enthusiasm. The cult accusation often comes from those who overlook infrastructure shifts and focus instead on surface-level market noise. They see a passionate community and interpret that passion as irrationality, rather than recognizing that communities tend to form around technology's position for long-term structural change. History shows this repeatedly, from the early days of personal computers to cloud computing, mobile technology, and electric vehicles. Communities don't form because technology is flawless. They form because there is shared recognition of potential, even when broader markets are slow to catch on. With G-Treasury joining the Ripple ecosystem and a regulated derivatives platform listing XRP, the gap between public perception and institutional infrastructure becomes increasingly visible. This is the type of gap that is often only understood in hindsight. Stepping back and viewing this through a wider lens makes the pattern clearer. Whenever a technology aims to reshape something as foundational as global financial plumbing, early discourse around it tends to be deeply polarized. One side dismisses it as unrealistic or overhyped. The other consists of individuals who have studied the mechanics, architecture, and long-term implications closely enough to see value where others see noise. This tension is not unique to XRP. It's a recurring theme across disruptive innovations. Accusations of cult-like behavior have been directed at early Apple investors, electric vehicle adopters, cloud computing advocates, and digital payment pioneers. When people rally around a long-term vision that markets haven't priced in yet, skepticism often defaults to mockery. It's easier to dismiss conviction than to analyze the fundamentals driving it. This matters now because infrastructure developments like the G-Treasury acquisition and the expansion of regulated exchanges suggest that digital settlement conversations are shifting from theory to implementation. Institutions don't adopt technology because of community enthusiasm. They adopt it when architecture aligns with operational needs, compliance frameworks are in place, and efficiency improvements are measurable. A key theme emerging today is that the tools institutions have always required, hedging mechanisms, derivatives, exposure management, settlement rails, and compliance-ready platforms, are beginning to converge with digital assets in ways they previously did not. This doesn't ensure adoption, but it increases the probability that certain networks become embedded within larger financial workflows over time. The bigger picture isn't about short-term price action or emotional sentiment. It's about how financial rails evolve. The transition from legacy settlement systems to blockchain-based rails was never going to happen overnight. It was always going to be incremental, driven by partnerships, regulatory clarity, liquidity pathways, and integration with existing financial products. Critics often argue from short-term perspectives, interest rates, market cycles, macro noise, and volatility. But when evaluating infrastructure-level technologies, those factors rarely determine long-term outcomes. What matters is utility. Does the technology solve real problems in payments, liquidity, and settlement? If XRP's infrastructure continues expanding in areas like cross-border settlement, liquidity optimization, and institutional risk management, market recognition will follow not because of online arguments, but because the architecture supports it. This brings the discussion back to the cult narrative. When a community aligns around a long-term technological vision, that alignment doesn't prove the vision correct, but it does indicate that the underlying thesis resonates with people who have examined it deeply. Strong, resilient communities emerge when there is shared recognition of potential, not blind faith. In tech history, those communities almost always appear well before broader markets fully understand the value. The real question isn't enthusiasm, it's whether the infrastructure justifies it. Are there real adoption pathways, institutional-grade platforms, and tangible use cases? In XRP's case, the foundation supporting the thesis is expanding, not shrinking. That's what matters from a macro standpoint. Translating this into practical implications, utility-driven assets gain relevance through integration, not speculation. When treasury systems explore blockchain rails, settlement providers expand frameworks, and regulated exchanges build compliant derivatives markets, it signals that digital assets are being assessed functionally rather than purely speculatively. For XRP, liquidity remains a central theme. Settlement systems depend on liquidity. Cross-border flows require liquidity. Regulated derivatives don't just enable speculation, they expand the liquidity stack by making XRP usable in environments where risk must be precisely managed. The G-Treasury acquisition adds another layer: connectivity. Integrating a firm linked to thousands of financial institutions into Ripple's ecosystem creates optional pathways for future settlement models, tokenized products, or liquidity solutions. Nothing here guarantees usage, but optionality is the first step toward adoption. Institutions adopt technology when it becomes available, compliant, and more efficient than existing alternatives. This is why the cult accusation misses the point. Enthusiasm isn't rooted in expectations of immediate results. It's rooted in observing a slow, consistent architectural shift that aligns with long-term infrastructure trends. What critics see as blind optimism is often simply recognition of a pattern unfolding gradually. Patterns matter in markets not because they promise outcomes, but because they shape probabilities. Large, informed communities matter because they drive analysis, debate, accountability, and continuous testing of ideas. That is the opposite of blind belief. For XRP, the combination of institutional infrastructure, regulatory frameworks, and expanding liquidity tools forms a foundation that did not exist years ago. Again, this doesn't dictate an outcome, but it shifts the conversation from theory to practice. In long-term financial systems, adoption rarely hinges on single events. It emerges through accumulation of partnerships, integrations, regulatory milestones, and infrastructure upgrades. XRP is seeing more of these developments now than in prior cycles. That is the real story behind the community's persistence. Not hype, not delusion, but alignment around long-term potential that continues to gain structural support. Bringing it all together, the criticism aimed at the XRP community doesn't hold up when you compare sentiment with real-world developments. While some focus on surface narratives, others pay attention to deeper shifts shaping the future of financial infrastructure. The G-Treasury acquisition expands Ripple's institutional reach, linking blockchain technology with established financial networks operating at scale. The launch of a CFTC-regulated exchange listing XRP from day one reflects a shift in how compliant markets engage with digital assets. Placed alongside a growing analytical community studying XRP's long-term role, the picture becomes far more grounded than critics suggest. This isn't about forecasting outcomes. It's about observing structural movement, the kind that historically precedes changes in financial systems. Communities form around long-term potential when that potential is supported by real progress. Whether you're bullish, neutral, or skeptical, the productive approach is to assess data with clarity and context. Short-term market conditions, political noise, and rate cycles influence sentiment but rarely determine long-term infrastructure viability. What matters is usefulness, institutional integration, liquidity depth, and architectural alignment with future settlement demands. The developments discussed today don't prove a future outcome for XRP, but they do explain why many continue to study this ecosystem closely. Enthusiasm isn't a weakness when paired with analysis. A large community isn't a flaw when built on shared research and long-term vision. Criticism doesn't erase progress when infrastructure keeps evolving. As always, this channel's purpose isn't to convince you, but to equip you with information so you can form your own view. Markets will change. New developments will emerge. Some expectations will be met, others won't. Staying informed, analytical, and grounded is the only way to navigate long-term trends effectively. If you found this discussion valuable, share your thoughts below. Which development stood out most to you? How do you view the gap between public perception and institutional infrastructure? Thank you for watching Journey to XRP. Stay informed, stay sharp, and as always, this content is for educational purposes only and not financial advice. Always conduct your own research before making investment decisions.